This is Brian Nates here, obviously, and I just wanted to. Here's my advice to you. Like, remember what you're doing with this type of policy. Okay, it is literally for the purpose of infinite banking or becoming your own banker, becoming your own banking system. You are truly replacing the function of banking, of where you're storing your dollars, of where you're storing capital before using it for other things if and when you decide to do so, like you're going to pay off debt with it, right? So that you can use those dollars more than once instead of just paying off the debt. The money's going into your policy first so that it creates a larger death benefit. It creates a way that the money's still working for you, even though you're going to pay off the debt with it. Like you're getting multiple functions for the same dollars. That's why it's called infinite banking, like infinite uses. And money flowing into your bank instead of flowing away from you into other banks. So when you really grasp that and understand that, you're actually going to flow as much money as you can through these policies so that you can use it for other things, but it's still doing something for you. It's still creating a larger legacy. It's still creating more capital to use. It's working for you, even though you used it for something else. Okay, so hope that helps. Keep in mind, like with infinite banking, the whole idea, the concept, it's not about the product itself, even though the details are important. I'm not, saying that, but it's about the process of replacing that function of where you're storing your capital and dollars before using it for other stuff so that it works for you in multiple ways, multiple times at the same time. Okay. But that being said, I'm going to go ahead and share my screen. First one on page 2. The policy provides a level amount. What is a level amount? Okay, so keep in mind that this is an illustration, right? This is not the contract itself. You haven't signed that yet, okay? But this is the illustration reflecting what the contract's going to be, okay? And level amount very much I mean, this is a whole life policy. The level amount on page 2, right? It's a whole life insurance policy which provides a level amount of insurance as long as the policy continues in force. So as long as you pay your premium, right? Easy enough. Makes sense. Okay. You need to understand that the way I designed this policy is to minimize that level amount, to minimize that base policy. Okay. And that can be broken down. Actually, I think it's page 12, 13. I'm going to go to it real quick. Okay. That can be broken down. And this may answer the other question you have, but I'll go back to it. So no big deal. Okay. But it can be broken down right here. The base policy, the level premium is this $117,000 worth of death benefit, right? And then you have the table D rating, okay? So you combine those two together, that's the level amount, okay? There's a $120 minimum that you'll have to do for the level premium paid up additions rider. That's paying up additional life insurance, which is where a lot of the cash value is coming from. Listen, this is a whole formula that I designed the policy with these different riders in it for your benefit of infinite banking. Okay. We make the base policy, which is the level premium, right? This 8,200 plus 18, so about 10 grand, right? We make that base policy, hear me on that, as low as we possibly can so that most of the dollars are being stored in the capital for cash value, right? In the paid up additions. If you notice the breakdown here, you have the 8,100 plus the rating, okay? And then the term rider plus the rating, right? And so most of the money, right, is going into, of the 50 grand every year, the minimum needed is 18 grand. Like we talked about before, you could take it from dividends if you need to, etc. Right? But a lot of the dollars are going into the paid up additions rider. The paid up additions riders is voluntary. You're choosing to do that. Okay, so the level premium is for the base policy. Okay, and then I'll explain more later. Okay, so hopefully that makes sense. Just know I'm happy to meet by Zoom and talk through this more. But there's a lot to cover here, so let me keep going. Page 4, the loan. Yeah, let me get to page 4 first. And I don't expect you to fully understand all this. I'm going to do my best, and we'll do whatever we can to help you. So page 4, the loan must be in amount that, when added to any existing policy loan, is not greater than your loan value. Where does it say the amount based on 150K? It's not an investment, by the way. Okay, so the way this policy is designed, most of the money is going into the paid up additions rider. Okay, there's a lump sum. I'm going all the way down to show it to you. There's a lump sum single premium paid up additions rider of 100 grand. And then 50 grand a year is the way this is designed at a maximum. Remember, we talked about that. Okay. But a lot of it, 31,000. So to combine 100 plus 31 is going into the paid up additions rider. The paid up additions is exactly what it says. What it sounds like. You're paying up additional rider. You're paying up additional contribution and additional death benefit into the policy. It's creating the death benefit to be more, which therefore is creating the cash value. The paid up additions is actually initially where all the cash value is coming from. Okay, so of the 150,000, like 131,000 is going into that paid up additions rider, right? So you have plenty available to take a loan against the policy like you need to. I think it was 85,000 or 90,000. You'll have access to almost immediately. If I had to do the math right, probably 110, 112, maybe even more thousand to take a loan against the policy to pay off the debt and use it like your own banking system. Okay. All right. So hopefully that helps there. Again, page 4, interest ranges. Let me go back to page 4, right here. Right here, the minimum loan rate is 0. The maximum loan rate is 8%. Who decides that amount? First question is, who decides that amount? The life insurance company. It is based on the market. Right now in 2025 for this year is 7%, but it's a simple interest loan, which means it's prorated throughout the year based on when you take the loan, what the dollar amount value, what the loan balance is. But it's this year 7%. Last year was 4.5%, 5. No, it was 5. The year before that was 4.5. Right. So it's based on the market. It's really not relevant, and it's a mindset for you, because when you're your own banking system, you're going to be utilizing the dollars twice, and you're going to be taking a loan against the policy. Yes, there's interest charged, and typically most of my clients will pay that interest every year. You don't have to. Okay, it can be added to the loan if you have room. It's fine. All right, but that hopefully answers that. The interest is every anniversary, right? So let's just say July 1st is when your effective date is on this. Every year, every renewal, there's going to be a new set rate for if you take any policy loans against the policy, and that fluctuates based on how the market's doing. Cool thing is the maximum it can be is 8%. Many times it will be in between that 4% and 7% range. It's the highest it's been right now for a while, for a long time. It's going to go back down. Okay. But that's where we're at with that. It's based on the market. When I say the market, the insurance company decides on that, but it's based on how. Remember, this is a mutual company, and they need to have a positive experience for everybody, even you as me and you as policy owners. We want everyone to be profitable and share that profit as dividends. So even though you're like, oh, what's the rate? All of it is mutual, right? We're all sharing the burden, I guess you could say, but we're also sharing the profit as dividends back into the policy. And there's been dividends almost 200 years in a row, right? So this isn't that big of a deal. even though mindset, I know you're probably like, what's the rate? I need to know the rate. It changes every year. And I hope that helps. Okay. But it's always between 0 and 8%. How long do I have to pay back the loan? You never have to pay back the loan. You're the bank. So how long does Denise want to pay back the loan? There's no minimum payment due. There's nothing. You never have to pay the loan back. I want you to hear that again. You never have to pay that loan back. Now, the art of using those dollars would say max fund the policy, like you plan on doing. When you take a loan against it, you should pay it back. It's a revolving line of credit, just like a credit card, right? So, like, if you pay it back, then you can use it again. So use it and pay it back. Use it, pay it back. Use it, pay it back. It becomes your own banking system. Okay, but you don't have to ever pay it back. There's no minimum payment due or anything. Okay. Okay. So page 6. Timing assumptions. Surrenders of paid up additions occur. Was it surrender paid occur at the beginning of each policy year? That is correct. You're probably like, what does that even mean? Okay, if you're gonna surrender the paid up additions that you used, it's based on the beginning of the year. Okay, you're never gonna do that unless you surrender the policy. Meaning like you're paying up additional life insurance, right? So if it's the beginning of the year, you can surrender that and not have to fund it any longer. Not, you'll collect any paid up additions in cash value. But I mean, you wouldn't do that. Like that's you closing down the policy. Okay, a lot of these wordings is legal jargon. Like this is an illustration. And some of the words in here, their legal department probably came up with, So, but just understand what that means. Hopefully, that makes sense. The loans and the loan payments occur at the end of each policy year. Yeah. So the loan itself, like it's not calculated as far as the interest until the end of the year, and it calculates at the beginning of each policy year, essentially, right at the end of each year. It's a simple interest loan, and it's actually prorated based on how many months you had the balance, and if it's different throughout the year, it's all prorated at the end of the year, and interest is due or interest is charged, I should say. So that's hopefully that's what that means. It says loan payments occur at the end of each policy year. Yeah, when you make a loan payment against the loan, it's all calculated. Now, again, it's prorated. Like when was the balance this month, this month, this month, this month, but it's all figured out at the end of each policy year. Okay, so it's almost like a credit card. You know how, like with a credit card, you can use those monies, but if you pay it off before the end of the month, you actually don't get charged any interest. Same type of thing, not exactly, right? But it's all prorated, and the interest itself is not even going to be charged or due till the end of each year, technically the beginning of the next year. Okay, it's calculated at the end. You'll get it. It gets charged. You could pay it, or it can be added to the loan balance if you have the room. Okay, all right. So hopefully that helps. Page 7. The TLR. That is called the term rider. I did a 10-year term rider. It is a term insurance rider. All I'm doing with this, okay, you notice how it's 1.225, okay? I needed to create a large enough death benefit for the dollars that you're putting into it, the $100,000 up front, and the 50,000, this year and up to 50,000 next year, etc. I needed to create a large enough death benefit so that your policy itself does not turn into a taxable event known as a MEC or modified endowment contract. We make enough. There's rules, okay, that you can only store so much capital inside of a life insurance contract per per dollar of death benefit. There's a ratio. There's a formula, and what we do in this industry for those that want to create an infinite banking policy, we'll add a 10-year term rider. Why do we do that? Because the cost of the life insurance that you need for the 10 years is significantly less by adding it as a term rider, which we know is going to fall off eventually. You won't need it after 10 years. Okay. It's going to fall off. And that's why the base, the level premium, is not much death benefit because your total death benefit is, 1 point whatever it is, right? We can look at that later. Just so I don't confuse you. I'm sure I already have. There's a lot here, right? But the total death benefit, I mean, you got 117,000. That's the level base. 1.2 million. So that's 1.3 something, right? But then you also got all these paid up additions. That's probably going to be another 50 grand in death benefit. That's like another 200,000 or so in death benefit. So, you're looking at, I mean, look at year one, your total death benefit is 1.5 million, right? It's right here, 1.5 million. Most of it is being designed for the first 10 years to be in that 10-year term rider. So the cost of insurance is significantly less for you, and that a lot of the dollars can go into the uh, paid up additions, which is where a lot of the cash value comes from. Okay. Hopefully that makes sense, right? Yeah. Page 8, level premium paid up additions rider. I kind of already explained that. But the rider for the level premium paid up, that's where a lot of the dollars is going and getting the cash value, especially immediately from. In future years, the dividends create more paid up additions, right? So the paid up additions adds more death benefit, okay, to the overall policy. The way infinite banking policies with a dividend paying whole life contract from a mutual company, which is what this is, the more death benefit you have, the larger the access to the cash value is. See, cash value is technically, contractually, an advance from the insurance company to you, the owner of the policy, that you have access to if you want to take it. It's really an advance of the future death benefit that if you die. Okay, that's really what it is. And so the larger the death benefit is, contractually, the larger the cash value has to be. Like, not maybe, not hopefully, will be. It has to. If the death benefit's going up, the access to capital and cash follows it immediately. It is connected together. Okay, so it's contractually guaranteed to work that way. So if you're paying up, which is what this is, level premium paid up additions rider, every time you're putting money towards that level premium paid up additions rider, you're paying up additional life insurance, which is death benefit. And because the additional death benefit's rising, so is the cash value, right? And it's typically dollar for dollar there in the cash value, right? So like 32 grand should create 32 grand of cash value, right? Really cool. And it's going to create like 50 grand of death benefit, maybe more, right? So usually it's around 2 times that. Okay, so pretty cool there. Page 11, the table is shown at 50% scale. Oh, that's simple. It's just showing that because it has, like, not has to, it wants to be super conservative, right? The company is saying, hey, if, now know this, Lafayette Life especially, but all dividend paying mutual companies, have paid dividends, have rewarded dividends over 100 years in a row. Lafayette Life's been around since oh my goodness, close to 200 years. I can get the year for you if you want me to. But literally, uh this is just being super conservative. Denise, that's all this is. It's saying, hey, you know what? We've performed at this level here, right? Sometimes even better. But if it only gets 50%, meaning the dividends is not as high as we're typically used to, then that's what's going to be here, 50% of them. And the guaranteed amount is saying, hey, if there's no dividends, which, let me be clear, there have always been dividends every year in a row because the dividend, remember, we're a mutual company, right? So it's not stockholders to pay and all that, right? There's profit, and the profit comes back in dividends to us to pay up more additional cash death benefit, which creates more cash value, right? But this is saying, hey, if there's no dividends, this is the guaranteed amount. If we only get 50% of what we're expecting to get in the dividends, this is the amount. And based on historical dividends, this is what we're showing on the illustrated scale there. Okay, so hopefully that helps. All right. And then I am confirming a loan is against the death benefit and not the net cash value. Okay. So yes and no. The loan, it is against the policy. You're taking a loan from the general fund of the insurance company. They're using your policy as collateral. So what do I mean by that? Technically, they're saying, hey, you're taking a loan against the net cash value. Okay? Meaning you can't take a loan for more than what the cash value is. Like you can't say in year five, hey, the net cash value is 286. I want a loan for 500,000. That is not how this works. Okay. The collateral is your life insurance policy, meaning like the net cash value is there. The net cash value is always growing. Remember, you're not touching those dollars, it's still growing. We're taking a loan against it to take a loan, to have the funds. So you can use the same dollars twice. Okay. But technically, like you have to follow the bouncing ball a little. Technically, like you, if you never paid it back, you die tomorrow. Then when in year five, you took out 200 grand, okay? Because there's 286 there. You die. You never pay it back. See the death benefit of 1.7? The first thing they're going to do is take the loan off the death benefit, right? Because you didn't pay it back and you died, right? So 1.7, now the death benefit's 1.5 because it's 200,000 that you owe. So you see how like it's technically a loan against the cash value, but not really because the death benefit is what is going to pay it if you never paid it back, right? So the reason it's against the cash value is because you can't go over what's been built inside of it, right? That's the maximum amount you can have as a loan against the policy. But the death benefit is what's actually going to pay it if you didn't pay it back. Okay, so hopefully that helps. All right, page 12. Page 12. When I look at the net cash value, it looks like just a savings account, no real return. Am I making the right assumption? I mean, sure. Keep in mind, like some of the dollars are being used to buy life insurance. Okay. There's a minimum, I think, with Lafayette Life, it's a 2% guaranteed amount in the growth side. Okay. And then with the non-guaranteed, it's the minimum plus the dividends, you know. Listen, I mean, last year, I think it was 5.75, it's always between four, well, I shouldn't say always. Typically, it's between 4 and 6%. I mean, contractually, that's where we're at with the guarantee amount, and then the dividends are on top of that. I can say every year of Lafayette Life's existence, there has been a dividend awarded. And once the dividend's awarded, that is guaranteed. They cannot take it back for that year. Every year, it's awarded and it's added back into the policy as paid up additions, which therefore creates a higher death benefit, which therefore that's why the cash value grows that year. Okay? Because remember, cash value, technically, contractually, is the insurance company saying, hey, we know your death benefit's this amount. We're going to let you take an advance up to, this amount, whatever the net cash value is. And, a way for them to say, if you want access to your death benefit early as a loan against the policy, you have that right. And that's why we use it that way. Okay. So how's that? Does that make sense? Like the guarantee side is a guarantee. Technically like a savings account, sure. But you shouldn't even worry about that because I'm not allowed, regulatory wise to say if you're going to get the dividends. But what I am allowed to say is every single year they have happened and they do not see any foreseeable year that it won't happen. It's not related to the stock market. Remember that. It's literally related to this is a mutual company. All the policyholders are funneling their monies and paying their premiums and putting their dollars here and storing capital here. Then they have expenses and, revenue minus expenses equals profit. Profit is dividends back to us as policyholders, right? So hope that helps. Technically, contractually, we overpaid and that's why it's more of a return because it's not taxable that way, right? If we mutually own a company together and there's excess funds, well, that means we should get back what we paid, right? That's what's happening, all right? So that's why there's no taxes on it as well. Okay. Okay, so the riders, 10-year term. I explained that already. LPUA, SPUA, ADBR. So let's go to that. You said the riders, 10-year term, 10YT. That's the 10-year term rider to make sure the cost of insurance for those 10 years is minimalized as much as possible so that you don't have to worry about the cost of insurance being more on you and more can go towards the cash value. That's what that's there for. The LPOA is the level paid up additions. SPUA is single paid up addition. That's the 100,000. That's again additional death benefit, creating cash value. Um, ADBR. So it's the advanced. Sorry, the A. That's I was trying to remember what the A. Advanced death benefit rider. Okay, terminal illness only. What that really means is ADBR is advanced death benefit rider. That for terminal, if you decide get terminally ill, cancer, something major, and you're deemed terminally ill, I think it's 12 months to live or less, you're allowed to take an advance of the death benefit to use for whatever you want. That is truly your choice. Okay. And it's really nice to know that. But yeah, it's completely your choice. It is a percentage of whatever the death benefit is. The longer you have the policy, and I can get those numbers if you need to see them. But if you ever needed to use the monies, you're more than welcome to. That is your right as a policy owner. So let's say, death benefit in year 10 is 2 million, and you get extremely terminally ill. Within the first 10 years, it's typically around 50%. As you age, it gets bigger. But let's say it's 50%. You could take $1 million tax free as an advance on the death benefit. It's a rider, and you can use it for medical bills. You can use it to travel around the world. You can just use it for whatever you want. It's your choice. It's your right. It's part of the policy, which is really nice. Okay. And the PDF, Premium Deposit Fund. All that is saying is if you wanted to store more dollars, I don't know if this has it in there. I don't think I put that in there because I don't think you need it. Yeah. So it's not here. It's a premium deposit fund. What does that mean? If you wanted to give more monies to the insurance company and they're going to put it in their savings account and crediting you, they can't attach it to the policy because you'll mech that policy and you can only put in so much for the year, right? If you wanted to tell the insurance company, hey, I got another 100 grand. I don't want to put it into the policy yet. I just want you to hold it for me. They'll credit you like 2% or something like that. It's a small little savings account model that they'll hold the dollars there for you and use the money there to pay the premiums as they come due. Some people do it, don't really need to, right? But that's what that is. So, and I think next question. I am putting in 150K and the face value. No, I mean the face value. You said I am putting in 150K and the face value is 117,828. That's the base level face amount, right? 117,000 right there, base face amount. Remember what I showed you earlier, okay? It probably is right here, right? The premiums is right all right here. Coverage amount, right? You see that? 1.2 million. But the face amount is just showing what the base policy coverage amount is, minimizing that as much as I can so that more money is going to the term rider and the paid up additions rider. So that actually creates a less cost of insurance. So when you say face amount is 117, that's just for the small base level premium. Remember when we said that 18 grand is the minimum? In reality, after the 10-year term rider falls off, the minimum is like 9 grand, right? 10 actually, if I add these two up, right? So about 10 grand is the minimum after year 10. Okay. So that's really cool for you to see. Really awesome for you to see that as well. You don't have to pay back the loan. Matter of fact, I would max fund the policy before paying back the loan, right? Because you can always pay back the loan later. You don't have to pay it back. Maybe pay the interest for the year. If not, it will get added to the loan balance. But always maximum the policy first. So I hope that helped. I'm going to stop sharing. That was a lot, but I hope that helped.